Are you investing outside the US? And what about gold? And do you worry about investing too much with one fund manager? These are some of the questions I'll be answering in today's Q&A. Hi from Central France. Question 1. What are some good income investments outside the US? Well, if you're a history buff, some of the buildings here could take you back 1,000 years. I'm visiting my friend who loves castles so much, he bought this 11th century one to live in. It's difficult to capture all of its grandeur on video, but I'll change the locations a few times during this episode so you can see more of it in the background. Of course, this channel is about much simpler investments you can make with just a few clicks sitting in your armchair, so this place doesn't count. The US has been great for income investing, but I'm open to diversifying further afield. At the moment, I have some diversification with funds like UTF. Just over 40% of the holdings are outside the US. It's yielding 7.5%. Then there's ASGI. It's even more diversified, roughly 2/3 outside the US, and it's yielding about 13%. I've been looking at emerging market debt funds like MSD and GHY. These hold investments like bonds issued by companies and governments. The yields are good, and as you'd expect, they've done well recently compared to the S&P 500. But over the longer term, they're not so exciting, as you can see from this 10-year total return chart. I'm still researching these two and haven't purchased either of them as I record this. I'm also looking at funds in Canada, Europe, and Asia. It's taking a while because there's less information available compared to funds based in the US. So in summary, I'm looking, yes, but it's still early days. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Next question, are there any good income investments based on gold? This is why gold is a hot topic at the moment. Since February 2025, it went the opposite direction of the S&P 500. However, over the long term, gold generally underperforms the S&P 500, as you can see on this 10-year total return chart. If you don't want to buy bars of gold, you can buy GLD to get exposure to the price action. I'm looking to keep my portfolio in the 8 to 12% yield range, and GLD pays nothing. But gold is so hot right now, and if you think the economy is going to deteriorate, gold is supposed to be a hedge. So I looked for gold funds that generate income using options or futures. The viewer asked about GGN. It's yielding 8.5%, which is right in my wheelhouse. It's not strictly gold, though. It also holds mining and natural resource stocks. I usually start with the distribution history and more cuts than a Ginsu knife commercial, so that one's out. Simplify offers YGLD, but it's less than 6 months old, and if you annualize the first distribution, which is all they've paid so far, the yield comes to less than 2%. Then there's YieldMax, and they have GDXY. That's a fund based on gold mining, and according to their website, it's yielding 61%. What could possibly go wrong? This one sells options on a gold mining ETF with the ticker GDX. Why make an income fund based on gold miners instead of actual gold? Because the options with the most volatility generate the highest income, and mining companies are more volatile than gold itself. GDXY has been around for just under 1 year, and as you'd expect, it recently pulled ahead of the S&P 500 for total return. The problem is that it distributes so much income that the net asset value erodes over time. If we ignore the income and look just at the price of the fund since inception, it's actually fallen 18%. And that's not great for a fund that started during a gold boom. The distributions are high because gold is doing well, but gold won't keep going up like this forever, and when it comes down again, I expect the price of GDXY to fall even harder. There's a more detailed explanation of why that 61% yield doesn't translate into long-term gains in this analysis by John Bowman. He also breaks down the difference between investing in gold versus gold mining. I'll include a link to John's article on Seeking Alpha in the description and a link for a free trial for Seeking Alpha and a discount. So as an income investor, I'm yet to find a gold fund that works for me. As an inflation hedge and a store of value, I prefer Bitcoin over gold. For example, I have some BTCI, which also pays a big yield. It's only been around since October 2024, but since launching, it has outperformed GDXY. The next question asks if income holds up better during a recession. There are a lot of ways to answer this question, but today I'm going to make it simple. We'll look at the effect of the last major recession on income. The 2008 global financial crisis was 17 years ago, and I have 7 investments that are at least that old. Actually, there's an 8th one, Capital Southwest, but they completely changed their business model in 2015, and before that, they paid hardly any income, so we'll skip that one. ARCC cut their dividend by 16.67% because of the 2008 GFC. That turned out to be their one and only cut. Not too bad. The utility fund UTG made no cuts. They have a perfect distribution history. Their competitor, UTF, cut by 62%, which is the worst in my portfolio. That would disqualify most funds from me even considering them, but they did redeem themselves by, number 1, never cutting again. That's a step in the right direction. And number 2, growing their price over the long term. Since their 2004 inception, UTF has kept up with the S&P 500, which is not easy to do for a utility income fund. PFN is a credit fund, and at the beginning of 2008, it was distributing 14 cents. The GFC caused them to cut down to just below 6 cents, which equates to a 58% cut. They missed 1 distribution in 2008 and 2 distributions in 2009. All of this would have been terrible, but for those investors who held to the end of 2009, there was a massive special distribution that completely turned things around. The result was that total distribution for 2009 was actually 35% higher than 2008. HTGC is a business development company, and their highest distribution for 2008 was 34 cents. There were 2 cuts, and by 2010, the distribution hit an all-time low of 20 cents. That's a 41% cut. No cuts since then, and the distribution went on to grow considerably. The last payment was 40 cents plus a 7-cent special distribution. Main Street Capital is another BDC, and it's a bit confusing to look at because they paid so many special distributions, but their story is simple. They've never made a cut. Last but not least is GOF, a diversified credit fund. This one is clear from the chart. There were no cuts whatsoever. So if you held all 7 of those back in 2008, there would have been some bumps in the road for sure, but when you blend it all together, the income held up reasonably well considering what a huge disaster the 2008 GFC was. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for the Armchair income discount and a free trial. Do you worry about diversification between fund managers? This comment contains a lot of questions, but I'll cover 2 of them. The easy one is that if you buy SPYI and QQQI, there is a lot of overlap because they're based on the S&P 500 and the NASDAQ 100. For example, Apple and Microsoft are large holdings for both of those. The weighted overlap is 46%, so holding both does not double your diversification. It roughly expands it by half. The other question I'll address is investing too much money with one fund manager. I'm glad that he mentioned NEOS because I've had thoughts about this too. I currently hold 4 NEOS funds, and together they comprise about 8% of my portfolio. Until recently, it was much higher than 8%, but I moved some holdings around in late March. Once we have some clarity on the tariff issue, I could see that number going north of, say, 20%. For somebody who likes to diversify, there has to be a limit to how much should be invested with one fund manager. The challenge for me going forward is that NEOS has quite a few funds that are a good fit for my portfolio. The yields are attractive, I understand their option strategy, and they make it easy to get exposure to a particular theme like the NASDAQ 100 or real estate or Bitcoin. To clarify, when the viewer asks about investing in a single company, that's not exactly what's happening. NEOS is a company or a business with revenue and expenses, but you can't invest in that entity. It's privately owned. If you buy shares in a NEOS fund, you own a percentage of the assets of that particular fund. So if you hold SPYI, you own a percentage of the S&P 500 portfolio that it holds and the income that it generates. There are many layers of separation and oversight that protect all ETFs, including NEOS, from fraud and abuse. I won't go into all of them today, but they include a separate entity for the fund, like a trust or corporation, a custodian that holds the fund's assets, a board of trustees or board of directors that independently oversee the fund manager and ensure they're delivering on the strategy outlined in the prospectus, and an independent auditor to make sure the financial statements are accurate. So I'm not worried about a fund manager running off with my money because they don't have access to it. The risk is limited to the fund manager's ability to navigate market conditions using the strategy described in the prospectus. So if the prospectus says they can't use leverage or they can't buy individual stocks outside of a particular index, then the fund managers have to work within those requirements. The risk is over-allocating to any one strategy, in this case, selling covered calls, because every asset class and every strategy has its weaknesses. Even if NEOS came out with 10 more funds that were a perfect fit for me, I would never invest the majority of my portfolio into one strategy. In round numbers, I expect my allocation to NEOS funds to top out in the future at no more than, say, 20 to 30%. The last question for today is asking what to do if the economy gets really bad. And I think they mean worse than a recession. Things like a debt spiral, hyperinflation, and the US dollar crashing. Without getting political, the amount of government influence in the direction of the stock market is unusually high. So it's not just about what the market is doing, it's also a matter of guessing what the government will do. That does increase the range of potential outcomes. I strongly suggest including bullish and bearish news sources in your media feed. If you only listen to bearish commentators, you will go crazy. There are plenty of events with potential upside for the market, including negotiations that reduce the tariffs to more manageable levels. If the market and the economy take a serious downturn, it'll be too late to make adjustments at that time. If it was possible to avoid losses in real time, nobody would experience losses. So you have to plan ahead, but you can only plan ahead for the range of outcomes that you think are most likely. If you're too cautious, you'll miss out on returns, and if you're not cautious enough, you could lose some of your capital. I would never tell other investors what they should do. I can only share my own approach, and I mitigate risk through diversification. You can't eliminate all risks, and if you truly prepare for the absolute worst case scenario, there's a cost to that. If you go to cash, it increases your exposure to the risk of inflation. If you buy gold bars, they could be stolen. If you buy a gold fund when you can only withdraw in dollars, and if the dollar crashes, well, that wouldn't work. My point is, if you try to eliminate all risk, life will probably suck. So, organize your portfolio to cover the most likely upside and downside. The upside may be better than you expect, which means you'll miss out on some profits, but that's all right. The downside might be worse than you expect, but you can't live a crappy life based on the small chance of that happening. With enough diversification, your total portfolio can withstand several major hits to individual asset classes. Well, that's 5 questions. Back to fund reviews and interviews in the coming weeks. But if you like this format, click here to continue the Q&A. More Armchair Income coming soon.
Armchair Income, that's my hustle and my groove.